Stockcast with Andy Tanner and the Rich Dad Stockcast, I should say, since that's kind of cool, actually.
Yeah.
Actually, in Robert Kiyosaki's studio right now, which is just, I think you can say this,
Awesome.
It's badass. It's pretty neat.
Cool.
All right, everybody in the audience, that we would discuss the Burry strategy, and it's personally the one I like more, because I believe there's two ways to make money this way. I think it incorporates the Andy Tanner, Warren Buffett. How do you like that? I link you with Warren Buffett.
I don't know. That's scary. I don't think you got to use Warren and me in the same sentence.
I'm going to keep doing it. Nope, you're brilliant.
I'm not worthy.
There's the Warren and Andy strategy that I believe Burry is using. But in addition to that, he's using an option strategy. So he's making money two ways. Is this correct, Andy?
Well, I don't know about I see a very distinct difference between the way Buffett would and Burry do it. What Burry is doing is, well, let's get jargony. Why not? If we're going to delve in, there's something called delta, and delta is just a change, right? And what Burry is saying is, as the market changes from a high place in the NASDAQ to a low place, I'm going to make money on that change. So just as someone might buy, a stock XYZ at 100 and it goes up to 200, they make money or a capital gain on that change. When you have a bearish position, it's simply going to make money on the change in the opposite direction. So he's making money on the movement of the market. Now, Warren Buffett is not like that. What Warren Buffett wants to do is own a business and make money off the profits of a business. So if you look at a stock, you might get a dividend. That's what Buffett really likes. He likes saying, hey, I got this great company. They're making underwear, they're making ketchup, or they're making video games or whatever it is. We make money by owning the business. And how does a business make money? By selling their stuff, right? And if the stock appreciates, that's great. But Buffett is very clear that operational earnings is most important. That's a direct quote from him.
Right.
So he's more worried. He's more concerned about, boy, can I pick up some bargains after this falls? That's what he's thinking. Burry's saying, no, I want to make money on the actual fall. That's the difference.
But isn't Burry, let's say Warren Buffett sees this as the perfect time to buy Apple because Apple's going to fall. He loves Apple fundamentally.
Wants to buy more.
So he wants to buy more. Isn't Burry doing the same thing? He's still going to buy Apple, but he's going to use his shorts or long-term puts to do it.
Actually, no. No. A put is your right or choice. An option is another word for choice. A put is a choice to sell something. So if Apple were to fall and you had puts on Apple, let's say you have the right to sell Apple at 200 and it falls to 150. In theory, you could buy at 150 and then you'd sell at 200 and make that $50 and you wouldn't own it, right? So the put option is not about ownership at all. It's actually about selling something. So he's selling something that he doesn't own yet. So it's a little confusing. That's why we have classes, right?
Okay.
That's why we have classes. But Burry's position of put options is he wants the right to sell this thing high in case he gets the chance to buy it low. But he's not interested in buying. A put option gives you the choice to sell, not to buy.
Okay, I'm gonna make this more confusing because I'm feeling extra dumb. I thought you could say, hey, Apple's at 200. I'm going to sell. So I'm using different words entirely. I'm going to sell you a put and promise you to buy it if it gets down to 100.
That would be on the other side of Burry's trade. And that's often where Buffett and myself reside.
Right.
I very might well be the person who sells Burry those puts because he's going to give me that money, right? And when it goes down, then I'm going to have to buy it from him, but I'm buying it low, right? So, the bottom line is I think here's a bigger issue. Rather than delving, if people want to learn about these things, we can teach them. We can make it simple, not in a half-hour podcast, but we can do it. But I think there's a point that I'd like to share that it might even be bigger. And it's something I've learned in Investor, and it's more of a big picture concept when I look at a trade like Burry. What are the emotions? I wish I could ask the person who did the tweet and ask me about the tweet. I'd like to know why he or she is interested. In other words, what emotions do you feel when there's a headline? Oh, Burry is taking 90% of his money and putting it in a put option, betting the market goes down. What does that do to people emotionally? I think a lot of people get what's called FOMO, the fear of missing out. They say, okay, he's a smart guy. He was in the Big Short. He cashed in before. He's taken another position. I should probably copy that, right? I should probably copy that. And I'll tell you, I think that's a very dangerous place to live. Not being confident in your own skin. For example, I understand exactly what Burry's doing, but I also understand that I have strategies of my own that are going to work just fine for me and help me achieve my goals. I don't need to abandon what I'm doing because Burry's doing something, right? And for everyone that looks at him and says, well, maybe we copy that, there's someone else that's equally intelligent often on the other side of that trade. So don't get caught up. Have confidence in what you know. Have confidence in what you do. That trade doesn't appeal to me one iota because I feel very confident in what I'm doing, and I have plans for up, down, sideways. They work for me. They're part of my cash flow blueprint, and I'm not going to let a trade in the news by someone who's been successful in the past derail what I'm doing. Very much the case, Burry could be right? But I think to myself, man, that's pretty risky to make sure you get the timing right. When you buy a put option, there's an expiration date on that, and the time decays on it. So Burry's losing money every day it doesn't crash. He's paid his rent and it's ticking away. And he may have a long enough term there. He might have different hedges. He might have different plans that people don't know about, right? It's just this headline, oh, Burry's, taking a bearish position. Oh my gosh, we should all hop in. It's not necessary. If you have dry powder and it does fall, you can buy those after the fact. Now you know it's happened, right? You have to guess. Now you know there's a good company here. You know there's a good price here. Let's pounce. Let's pounce. So while Buffett is keeping dry powder for that strategy, which is the one I prefer, if you look at the history of Kenny McElroy, Kim, and Robert, that's exactly what they did. I shouldn't put words in their mouth, but I've heard them talk about it. In the subprime meltdown, they bought after the fact. When the thing crashed, they said, okay, now we're going to pounce. And they got unbelievably richer because they bought after the fact. So, yeah, you can certainly sell a put and get paid to buy low. But Burry didn't sell puts, he bought them.
Gotcha.
So he's on the other.
Okay.
He's on the other side of that trade, right? Yeah, he's on the other side of that. Often, I am the person that is selling someone like Burry those puts. I'm like, man,
Okay, so then it's actually the Warren Buffett, Andy Tanner strategy that has.
I hate it when you do. Don't call it the Andy Tanner strategy.
It's too late. It's already done. It's like somebody put it in etch and stone. I don't know.
Yeah, one little difference. When I sell a put, I usually do it way, way low where I think the market might go. Okay. Burry's not doing that. He's selling those at a high strike, expecting the opportunity where he could buy low and then sell high. And that would boost the intrinsic value of that put. So there are huge differences, which just speaks to the value of taking some time and really getting the education.
But you're selling puts on stocks that you believe to be fundamentally strong. So you're making money on the selling of the put, but you're also making money by buying quality stocks so low and then
price
for the dividends.
Dead on. That is the opportunity. For example, when I see in COVID, when I saw the airlines starting to drop, I knew Buffett was going to get out of the airlines. Another example of not getting caught up in what a smart guy was doing, right? Buffett said, I'm out of the airlines because they're not going to be making money for a while. The way I looked at it, I'm a lot younger than he is. And I'm like, they'll rebound. We'll fly again. So when I saw the airlines starting to tank during COVID, I actually said, hey, I'm going to sell some puts down here that give me the right to buy even lower, right? Some of them got that low and I bought. Some of them didn't get that low and I just kept the premiums.
Right. You made money either way. All right. So I want to address something else because one of the things we get here at Rich Dad all the time is I'm afraid to get in the stock market because it's in a bubble. and I'm terrified I'm going to get in and it's going to pop. But I just want to point out that both Warren Buffett and Michael Burry are actually using strategies to take advantage of this. So especially Burry, he's actually investing in the stock market
Absolutely.
because it's in a bubble. And so I think that, and here's what I'm going to ask you, because I don't want to give my opinion because that would be stupid. I think that there isn't a wrong time to get into the stock market based on your education. So if you're educated enough, you're going to make money in the burst. And if you're maybe less educated, you need to make your money on the upswing. Can you?
Yeah, I think let's speak to the fear first. People that I really recommend a book called The Intelligent Investor by Benjamin Graham. It's just a sage giving us wisdom that's timeless and principles that are true in all cases. And people who are obsessed with price are the people that are worried about stocks. People that decry stocks are about price. Well, the paper's going to be worthless, and price. But true investors are not interested in the price so much as they're worried about the work that's being done by the asset, the value it gives to the community and the world, and the earnings. In real estate, we call this net operating income. That is a huge number to understand that I'm giving a valuable service, I've got good, clean housing for people, and I have a great net operating income. Those numbers are huge, more so than prices, because prices fluctuate with opinions all the time. So people that are afraid to get in the stock market because it might have a price fluctuation, they're traders. They're just like house flippers. They're speculators. They're not true investors. A better way to look at it is to play either the cash flow game or play Monopoly. Either one is fine. If you play Monopoly, when you land on something that's for sale, you freaking buy it. That's it. The answer is to own assets. And in every instance, the person who owns assets is better off, especially if they cash flow. Because if the assets are cash flowing, who the hell cares what the price is? I've had times with my real estate where I watch my little, I have syndication money and I have single family home money, right? So as far as the single family home stuff goes, Zillow will send me an email that says, oh, the price dropped, X%. I don't even care. It didn't take money out of my pocket. I get rent. Right. Now, if the rent stopped, then we'd have a problem. But as long as that rent comes in, up, down, whatever, up, down. Well, the same is true with stocks, is if I can sell options. Think of it this way. Do you buy a golden goose because you think you'll sell it higher next week or because you want the eggs?
Right.
And so people, I'm not going to buy a golden goose because the price of golden goose might crash next week. What? No, I worry about the eggs coming out of that thing's hind end, right? I'm there with my catcher's mitt ready to catch the golden egg. So that's why, I named my company the Cash Flow Academy, not the Capital Gains Society. We are about, if you play cash flow, the game, you look at it, and if the thing cash flows, you buy it. It's that simple. You don't worry about price here and there and all this stuff. That's that. If you can take that real estate cash flow investing mentality and apply it to business, you can be a stock owner anytime. And here's the other thing, Greg. There's always a bargain, man. There's always someone worried about this, that, and the other. One of my favorite things to do is I love to watch Buffett's portfolio. And any times the prices go below what he bought at, I buy. Right? Like he bought Kraft Heinz at 70. That's what he paid for it. 70. Right. It's at like 30 something right now. I bought it at 30. And it hasn't moved in I've owned that thing for probably 4 or 5 years, 5, 6 years. And it's just, gone. But the dividends have been solid and the option premium has been solid. And eventually, this is a big key for those that worry about price crashing. I don't need the prices to move up or down. If you bought a golden goose that laid golden eggs, the eggs would eventually pay for the goose, no matter what you paid for it. So if you pay $10 for the goose and each egg is worth $1, 10 eggs, you've got your money out, you're at infinite return. And I didn't even discuss the price moving on the goose. Right. The eggs will pay for the goose. the rent will pay for the house. You know, the renters pay for the house. So whatever I paid for it, who cares? The renters will pay for that house eventually. And it's never a bad idea to buy assets. Never a bad idea. Up, down, or sideways, what do we care? I don't care where the market goes. I just want the assets.
Such a funny comment.
Is that a rant? That was like close to a rant, I think.
Yeah.
I felt my heart. I got my Apple Watch telling me my heart rate's up. That must have been the sort of a rant. Buy assets. Quit worrying about the freaking price of everything and buy some assets, right?
That is a bit of a hot button. You know what? I should write that down to trigger you every week. That would just be funny. We do got to wrap up. But before
we'll talk more about this.
Everybody, Andy did write a book. It's called The Power of Six. He's offering it free for you right now. Go down in the descriptions. There's a link in there. No cost. And you can learn a lot about what Andy's talking about with the value of numbers, fundamental, the Andy Tanner / Warren Buffett style of investing. And I highly recommend you get that. So, Andy, I think we need to end the show and talk next week.
Hey, first, thank you so much, Greg. I've enjoyed the re-arrival or the resurgence of the Stockcast. Our lives have aligned now to where we have the time to do it. And it's just been great. And also to everyone that listens, wonderful to get your comments. Everyone says like and subscribe, which we hope you do, but also comment. And we can discuss and draw subject matter from what you want to hear about. And I'm not an expert on everything, but I'm happy to opine to the degree that I can. I hope it's helpful to bring a context shift to you. So thank you, Greg.
Agreed. Thank you, Andy. Thanks for the brilliance. I'll talk to you next week.
This podcast is a presentation of Rich Dad Media Network.